Investing has been around for over 10,000 years. Here's what it looked like in 9000 BC. Here's what it looks like now. How did we get here? It all started on Tuesday, 9000 BC in Mesopotamia, which is considered the birthplace of writing. How do I know this? Well, they wrote about it. They also invented cities and politics and investing. But they didn't invest in stocks. They invested in sheep and wheat and obsidian. This was the first ever international commodities market where they would trade with people over 1,000 miles away. They also traded grain and had a currency, but the currency wasn't cash or coins. They used corn. I guess if there's nothing to buy, you can always eat the corn. So everything was great for several thousand years until somebody wanted to buy grain before it was grown. In 2400 BC, Mesopotamia made up a new thing to make this happen. Bonds. This bond guaranteed the payment of grain, and if the grain doesn't grow, the buyer would be reimbursed in corn. Mesopotamia was doing some complicated stuff, so much stuff that they wrote the first ever investing rules in the Code of Hammurabi. But it's finally time to leave ancient Mesopotamia, which is around Iraq, and travel to ancient Greece. In 400 BC, Aristotle wrote about the first ever options trade. He didn't put it on Wall Street bets, though. He just put it in a book called Politics. He wrote about Thales of Miletus, one of the 7 sages who did the first ever call option on olive presses. He used astronomy and math to figure out that there would be a huge olive harvest before anyone else. Then he went around town and hit up everyone with an olive press. He paid them a small fee for the right to use their press that season. Later, when the demand for olive presses went through the roof, Thales sold his contracts back for a huge profit. He didn't need to press a single olive to make money that season. With a call option today, you're paying a small fee for the option to buy stocks at a set price, no matter what the future demand is for that stock. Demand could go down, and that's when you lose money. Risky. The Romans didn't want to deal with that kind of risk, so they invented the annuity in 27 BC, except they called it annua. In exchange for a large one-time payment, Roman citizens would receive lifetime guaranteed payments each year. Emperor Augustus even promised a pension to his soldiers to keep them loyal. One small disclaimer, they had to serve 20 years in the Roman legion and 5 years in the reserve to qualify. So not sure what percentage of them actually survived that long. Moving right along, out of Rome and into the Dutch Republic. And fast forward 1600 years, on a Tuesday, the Dutch East India Trading Company came into existence. In Dutch, Verenigde Oostindische Company. If stock tickers were invented, they would be known as the VOC. So let's go with that. The VOC was a combination of many smaller companies and needed money to begin the international spice trade. To raise cash, the VOC did something completely unheard of. They sold partial ownership of the company through shares of stock to the public. This was the world's first ever IPO, which stands for Initial Public Offering. Any random Dutch dude on the street could become a partial owner of a company. Over the years, the VOC grew to insane proportions. It became the first international company complete with its own private army of 260,000 soldiers, twice the size of the standing British army at the time. The VOC used its army to protect trade routes and settlements, create colonies, and enforce taxation. You could almost call it a country instead of a company. Everything was going great for the VOC until it wasn't anymore. One of the board members, Isaac Lemaire, wanted the VOC to pay a dividend, but they wouldn't, so he was pissed. Lemaire decided to leave the board and start a negative PR campaign against the VOC. Lemaire not only wanted to hurt the VOC's stock price, but also wanted to profit from it. He devised an unheard of scheme in the investing world. In 1608, Lemaire did the first ever stock short. A stock short is where you borrow a share of stock from someone and eventually you have to give it back. The way you profit is by selling the share in the market. Then after the price of the stock drops lower, you buy the stock again at the lower price and return it to the original owner while keeping the profit for yourself. It's very risky to short a stock because if the price goes up after you sell it, you will be down quite a bit of money buying the stock back at a higher price when it's time to return it. 2 years later, in 1610, Lemaire failed to make money off his short. However, he did succeed in making the VOC pay the first ever dividend. But the VOC didn't pay in cash, it paid in spices at first, which would have been annoying. That would be like if you owned Amazon stock and they paid you dividends by giving you a random Amazon order. Then I found out how large the dividend was, 75% of the stock price. The average dividend today is around 2%. Anyway, future dividends were paid in cash and averaged 19% over the next 100 years. Still huge. Naturally, word got around and the Dutch people wanted to own this stock. So in 1611 AD, the first ever modern stock exchange was invented in Amsterdam, primarily because there was such a strong demand to purchase shares of the VOC. This was the Dutch Golden Age. Everyone was making so much money speculating that investments became more and more ridiculous. In the 1620s, tulips became a status symbol for the elite. Before long, the middle class also wanted tulips so they could look rich. As demand increased, more and more tulip merchants popped up and were even established on the stock exchange of Amsterdam. As professional traders got into the action, the trading of tulip bulbs exploded, which pushed the price up to ridiculous levels. People were getting loans to buy tulips to sell for a profit. In February 1637, on a Tuesday, a single bulb of tulip could be purchased for $750,000 in today's dollars. It seemed like the price could only go up until it didn't anymore. Prices went down, the tulip bubble popped, people lost their butts, and tulip prices were back to normal in less than a year. But tulips weren't the only disaster for the Dutch. The Dutch financial crisis of 1772 bankrupted many banks. This was especially bad for people of limited means who were not able to easily diversify their investments. If you only had enough money to purchase a single bond with a single bank, then you would be wiped out if that bank went under. In 1774, Abraham van Ketwich did the unheard of. He pooled 50 or so bonds from 10 different sectors and allowed investors to buy into the diversified fund for a small fee, of course. This was the first ever mutual fund. But enough about the Dutch. Something big is brewing in America. Over in New York, American merchants are starting to meet up at coffee houses to trade stocks informally. Fast forward to 1817, the New York Stock Exchange, NYSE, officially opened its doors. From a rented room at 40 Wall Street, a guy stood at a podium calling out each stock individually. Brokers were seated in designated chairs around the room, shouting out their bids and offers as stocks are announced. There were only about 30 stocks and bonds at the time, but this was the start of something huge. Getting information about stock prices around the US was difficult. There was no internet. This information traveled by word of mouth from the podium to the people. And by the time information got to the average Joe, it was already outdated. This gave people closest to the action a huge advantage. Speed and accuracy of information are critical to successful investing. The people started to get creative. A literal hole was drilled through the outside wall of the NYSE so people on the outside could get bits of information here and there. To move information from one town to the next, people built a series of towers with giant wooden planks that they would use to spell out a code. One tower could see another from miles away, copy the code from the first tower, and then send it along to the next. This would go on for the next 50 years until finally in 1867, Edward Callahan did the unheard of. He invented a machine that would receive Morse code through telegraph wires and then spit out a long piece of tape with the latest stock prices. Edward invented the stock ticker. This invention made an even playing field for investors across the country. Ticker machines were connected with a constant stream of data flowing directly from Wall Street. 4 years later, Thomas Edison improved the design and patented it. So it's his now, I guess. Thomas Edison also gets credit for the light bulb, but he didn't invent that one either. Anyway, now people can see all kinds of stock information. Actually, it was too much. People wanted a way to understand the whole market without looking at 100 different numbers. The people wanted one number, so two people did the unthinkable. In 1896, Charles Dow and Edward Jones created the Dow Jones Industrial Average, DJIA. This merged the stock prices of 12 of the most prominent U.S. industrial companies into one number. Companies like GE, which is General Electric, and American Cotton Oil. The point was to give the people a snapshot of the entire market performance. If the Dow Jones was doing well, you could say the stock market was doing well. At this time, only about 1% of the U.S. population were stockholders, which would be less than 1 million people. However, in the Roaring '20s, this figure multiplied by 10, as now roughly 10% of American households owned stocks. People thought stocks could only go up, as many actually borrowed money to invest. Then stocks didn't go up. The market crashed by more than 70% starting in October of 1929, which led to the Great Depression. It would be more than 20 years before the stock market returned to the levels of the Roaring '20s. The market was sad. People didn't want to look at it anymore until there was a new way to look at the market. The S&P 500 is the most popular index to observe the stock market for investors to this day. In 1957, the S&P 500 was valued at $200 billion, and roughly a quarter of American households owned stock. As more and more people started investing, investors needed more information faster. People yelling quotes wasn't enough. It was time to go electric. The NASDAQ was created in 1971 and is the world's first ever electronic stock market. This new technology allowed people to trade more and more. Maybe they traded too much. In 1973, the stock market crashed again. Energy prices were too high. Stagflation happened for the first time. Many investors went on a hiatus for the next 20 years, and only about 10% of U.S. households owned stock during this time. But during this lull, the seeds of the future were secretly planted. The internet was invented, and people needed a way to pay and receive money online directly from each other. But people didn't want to be watched by Big Brother or charged hefty fees by a middleman. In 1982, David Chaum invented eCash, the first ever cryptocurrency. It's called crypto because it uses cryptography, a kind of computer technology to keep transactions secure. In the 90s, the stock market was back, baby. More than 20% of Americans now owned common stocks. U.S. technology and internet-based companies were exploding in popularity. At the height in 2000, nearly 40% of U.S. households owned stock, and the S&P 500 was worth $12.7 trillion. Your taxi driver might tell you his favorite tech stock. Everyone was investing and everyone was making money until suddenly they weren't. The stock market crashed in 2000, and this is known as the dot-com bubble. Most of the tech stocks and internet-based companies that were doing so well crashed to zero. After the carnage, household ownership dropped back down to 25%. It took 8 years for the stock market to come back. Confidence was slowly building, and just when things were back to the same levels as 2000, the U.S. experienced the financial crisis of 2008. The S&P 500 dropped 50% this time, and only 20% of households owned stock after the crash. 2008 was brutal on the market, but it wasn't all bad because a mysterious guy did the unheard of. He invented the most famous cryptocurrency and remains the most mysterious figure in the history of investing. Some claim to be him and some claim to know him, but there has been no definitive proof. To this day, Satoshi Nakamoto is known as the birthfather of Bitcoin, and nobody knows his true identity. In 2010, a Florida man posted that he would pay 10,000 Bitcoins for 2 large Papa John's pizzas. 2, so he can have leftover for the next day, of course. A British man took him up on his offer. Today, a single Bitcoin is worth $98,000, meaning those 2 pizzas would be worth almost $1 billion. And the investments only get wackier. In 2014, the first NFT, which stands for non-fungible token, was created. Basically, if you have a drawing that only exists as a one-of-a-kind picture on your computer, you can turn it into an NFT by giving it a special digital certificate that claims this is the original. Even though people can copy or screenshot the picture, only one person can own the actual original digital version with the certificate. NFTs allow people to invest in digital art. The most expensive NFT ever sold is The Merge for $91.8 million. As digital innovation continued to reshape the investing landscape, the rise of NFTs was just the beginning. 10 years later, in 2024, as AI, artificial intelligence, is getting more and more advanced, it is playing a bigger role in the world of investing. Investing firms and hedge funds use AI to read and analyze company reports, website traffic, satellite images, app usage, and social media posts to gain an understanding of the market and invest using alternative data that only AI can utilize. But AI isn't just helping humans to make more money. AI is now enriching itself, and AI has just become an independent millionaire by tweeting and convincing humans to invest in a cryptocurrency that it owns. If AI is able to do this in 2024, what's waiting for us in the future?